September 23, 1998. A conference room inside the Federal Reserve Bank of New York. There are no cameras, no journalists, just 16 men in dark suits sitting around a table that's too small for what's about to happen. They represent 14 of the most powerful financial institutions on the planet. Goldman Sachs, Morgan Stanley, JP Morgan, Merrill Lynch, Deutsche Bank. The people who move the world's money. And they have a problem. Somewhere in Greenwich, Connecticut, there's a hedge fund. It manages $4 billion in capital, but that's not the problem. The problem is what that fund has done with those $4 billion. It has used them to build positions worth over $125 billion. And those positions are now collapsing at a rate of roughly $500 million per day. If this fund goes down, it doesn't go down alone. It takes the banks with it. And if the banks go down, the men in the room have 72 hours, maybe less. But here's the part that keeps me up at night. The fund that almost destroyed the global financial system, it was run by the smartest people alive. And that's exactly why it failed. To understand how the smartest people in finance nearly crashed the world economy, you need to meet them. John Meriwether. In the 1980s, he was the king of bond trading at Salomon Brothers, one of the most powerful investment banks in history. The traders on his desk didn't just make money. They made the kind of money that made other traders quit and go home. Meriwether built a culture of math-obsessed, hyper-competitive traders who believed that the markets weren't random noise. They were a puzzle, and puzzles can be solved. Then there was Myron Scholes and Robert Merton. These two weren't traders. They were academics, mathematicians, and they had done something nobody in the history of finance had ever done before. They had written an equation that could accurately price risk. The Black-Scholes equation. I'm not going to explain the math. What matters for our story is what the equation meant psychologically. Before Black-Scholes, pricing an option was essentially a guess. After Black-Scholes, it was science. And the people who wrote it believed, truly, deeply believed, that they had solved the fundamental problem of financial markets. In 1993, Meriwether called Scholes and Merton with an idea. What if they took the equation out of the classroom and put it to work? Not managing a few million, managing billions. They called it long-term capital management, LTCM. The name tells you everything about their confidence. This wasn't a hedge fund with a clever brand name. It was a statement. We think long-term, we manage capital, and we are the management. Wall Street agreed. When word got out that Meriwether, Scholes, and Merton were raising money, banks didn't just invest. They competed for the privilege of investing. The minimum buy-in was $10 million, and there was a 3-year lockup. You couldn't touch your money for 3 years. Nobody cared. The Italian Central Bank invested. University endowments invested. CEOs invested their personal savings. By the time LTCM opened for business in February 1994, it had raised over $1 billion. And then it started printing money. Year 1, 21% return after fees. Not bad, but not legendary. Meriwether's old desk at Salomon had done better. The investors were patient. The math needed time. Year 2, 43%. Year 3, 41%. Now we're talking. To put this in perspective, if you had invested the minimum $10 million in February 1994, by the end of 1997, your money had more than doubled. You had $27 million. And you hadn't done anything. You hadn't made a single decision. You just gave your money to the smartest people in the room and let the math work. The partners themselves were reportedly playing golf during trading hours. Why wouldn't they? The models were running, the trades were executing, the returns were arriving like clockwork. And in October 1997, the ultimate validation arrived. Myron Scholes and Robert Merton won the Nobel Prize in economics for the Black-Scholes equation. The same equation that was, at that very moment, generating hundreds of millions of dollars in profits for their fund. Think about that for a second. Imagine you're an investor in LTCM. The guys managing your money just won the Nobel Prize for the exact strategy they're using to make you rich. It would be like finding out your pilot was also the person who invented the airplane. At this point, LTCM wasn't just a hedge fund. It was proof. Proof that the markets could be understood, that risk could be quantified, that the right equation in the right hands made losing almost impossible. Almost. Here's what nobody talks about. By 1997, the fund had a problem that had nothing to do with math. It had too much money. LTCM's original strategy, finding tiny mispricings between similar bonds and betting they would converge, worked beautifully. But those opportunities were small, and LTCM's capital base was now enormous. So the fund did what ambitious funds always do. It looked for new places to put money. Emerging markets, Russian government bonds, Danish mortgage bonds, equity volatility in multiple countries, bets on mergers, positions that had nothing to do with the original thesis. Black-Scholes himself pushed back. He warned the other partners that they were entering markets where they had no informational advantage, markets they didn't understand the way they understood US Treasury bonds. He was overruled. And here's the detail that I think is the most important in this entire story. The detail that separates what happened to LTCM from a simple bad luck story. The fund's leverage. For every $1 of actual capital LTCM had, it borrowed approximately $25. Its total positions were over $125 billion on a capital base of roughly $5 billion. Why? Because the model said it was safe. The probability of a loss large enough to threaten the fund was, according to their calculations, astronomically small. A 10 sigma event, something that should happen once every several billion years. The models assume that markets are efficient, that prices move smoothly, that the future looks roughly like the past, that when things go wrong in one part of the world, other parts of the world continue to function normally. Every single one of those assumptions was about to be proven wrong. Simultaneously. July 1997. Thailand's currency collapses. The Asian financial crisis begins. Within months, it spreads to Indonesia, South Korea, and Japan. Markets that were supposed to be independent of each other suddenly start moving in lockstep, in the wrong direction. LTCM's models don't panic. They see opportunity. The fund takes larger positions, betting that the panic is temporary and prices will revert to normal. That's what the math says. Then, August 17, 1998, Russia defaults on its government debt. This wasn't supposed to happen. Russia was a nuclear power. It had the backing of the International Monetary Fund. A sovereign default of this magnitude was, in the language of the models, impossible. Except, it happened. And when it happened, every investor in the world did the same thing at the same time. They ran. They sold everything risky and bought everything safe. US Treasury bonds, the safest asset in the world, skyrocketed in price. Everything else collapsed. LTCM was on the wrong side of almost every one of these trades. The losses were staggering. In August 1998 alone, the fund lost 44% of its value. At its peak, it was losing over $500 million in a single day. The model said, hold, the positions will converge. The math is right. But here's the thing about math. Math doesn't need to pay its bills. LTCM did. On September 21st, Bear Stearns, the bank that processed all of LTCM's trades, called in a $500 million payment. The fund didn't have it. And now the nightmare scenario was real. If LTCM defaulted on its obligations, every bank that had lent it money would take massive losses. Those losses would trigger more selling, more panic, a chain reaction through the entire global financial system. $4.5 billion gone in less than 4 months. On September 23rd, the Federal Reserve organized the bailout. 14 banks put in $3.65 billion to prevent a systemic collapse. It worked. The financial system survived. But I don't want to end this story with a bailout. I want to end it with the question that actually matters. What went wrong? Because here's what most people get wrong about LTCM. They think the lesson is, the math was wrong, the equation was flawed, the models failed. That's not the lesson. The Black-Scholes equation is brilliant. It's one of the greatest intellectual achievements in the history of finance. It's used every single day by every major bank, every options trader, every risk manager in the world. It works. The equation wasn't the problem. The problem was what happened between the equation and the real world, the translation layer, the human layer. The part where brilliant people looked at a model that said, this works under these specific conditions, and decided it meant, this works everywhere, all the time, at any scale. Scholes and Merton knew the assumptions of their model. They literally wrote the assumptions. They knew the model assumed smooth price movements, rational actors, and unlimited liquidity. They knew the real world didn't always look like that. But when the money was flowing, and the Nobel Prize was on the shelf, and every bank in the world was begging to give them more capital, the assumptions became invisible. This is the uncomfortable truth. It's not a story about bad math. It's a story about smart people who forgot the difference between a model and reality. And here's why this matters to you, right now in 2026. Today, artificial intelligence runs a significant and growing portion of global trading. AI algorithms make millions of decisions per second, moving trillions of dollars, using models that are orders of magnitude more complex than anything LTCM ever built. And those models are trained on the same assumption that LTCM made, the assumption that the future will look like the past, that patterns in historical data will hold, that markets are fundamentally rational. We are running the same experiment again, with bigger numbers, with faster machines, with more leverage. And the one thing we know for certain about this experiment is that it's been run before. And it failed. One more thing. After LTCM was bailed out and liquidated, John Merriweather didn't retire. He didn't write a memoir about lessons learned. He started a new hedge fund called JWM Associates. It used similar strategies, similar leverage, similar models. In 2008, during the next global financial crisis, a crisis caused in part by the same kind of mathematical overconfidence that destroyed LTCM, JWM Associates lost 44% of its value. Merriweather closed the fund. Then he started another one. Some lessons have to be learned more than once.